Good afternoon, everyone, and welcome to this midsummer webinar on the financial markets. Lots happened in the last quarter, which we'll be looking at in some detail. But before we do that, I just wanted to welcome some new members of the audience. We keep gaining in popularity, so thank you very much for listening. But for those of you, of course, who are new to this for the first time, I'd just like to give you a brief overview of what's about to happen. So we look at things really in three ways. We identify the main market drivers. Those are the stories, the events, the economic forces, so to speak, that propel financial markets to where they go. Then we look at sort of technicals. We look at performance, various sectors, markets, and then finally we'll wager an outlook using a few indicators and risk monitors and trying to gaze into our crystal ball. It's very picture heavy. Each section has around 10 graphs that will hopefully provide interest, and ultimately we want to be done in about 30 minutes and leave it open for Q&A. And please do write in at the bottom of your screen if you come across anything that we've talked about, or if there's anything you want us to delve deeper, and Hannah will collate these at the end of the webinar and we'll promise to get to them. So without further ado, here's what's been happening. You'll see the new visuals that we've created to make it all the more exciting. This is where we always start. It's with a perspective. So this is the FTSE All World Index, which is one of the broadest benchmarks that people look at for the equities markets, which is obviously where a lot of price discovery takes place. It has its flaws, its index, but there's also nothing wrong with it. And as such, it's as good as anything to look at. And as you shall see, what we've done here is we've looked at closing prices over a period of 15 years. Why? Because that's when we came out of the great financial crisis, which changed everything, amongst which quantitative easing. And there you can see by regressing this trend, so this is one standard deviation, two standard deviations, you'd think nothing much happened if it weren't for this little dip here that, of course, occurred in April. But other than that, this has been a wonderful bull market and seems to be at the top of the game at the moment. Inflation in the US, and again, we always look at the US markets because they lead. They're the biggest by far in the world, and you always get the best data there as well. So forgive us for this little US-centric bias in our analysis, but inflation in the US is tamed, has come a long way, obviously, but not quite to where we want to be at the sort of two level, and where the Fed has indicated that they will cut, much to President Trump's chagrin. Growth is also kind of back to where we are. So this is a OECD lead indicator of growth, economic growth indicators, and you can see the big dip back in 2020 when things went to zero. But since then, we had this huge stimulus induced rally. Then we came back down to earth. We had to slow down the economy to get the inflation under control. And here we are, kind of in the middle of, well, not nowhere, but things are good. There's nothing wrong with a growth rate above 100, and we're kind of in line with historics, even with this great event that shook financial markets to their core. These are the rate cut expectations in the US. So we look at the implied rates of where the forward markets are trading. So this is where the markets see rates being going forward in time. And from there, we can interpolate how many rate cuts there are going to be. Why are rate cuts good? Because that's what drives market liquidity. It's kind of like an elixir, so to speak, and people like it. To the left is where we were last quarter. We tend to look at things on a relative basis to also understand the trend. So you can see that, and I'm taking here now the end of the year. So by the end of the year, back in April, we were expecting 3.5 rate cuts, and that implied sort of a terminal rate of 3.5 in the US. Currently, the rates are 4.5. And now, 3 months forward, looking at again at the end of the year. So now, less rate cuts, but that's because we already were pricing in them before, although this hasn't changed. And here's now where this has come from. We've taken, a good rate cut and a half off the table. Normally that isn't a good thing, and you would have thought that markets would react, but as you saw, the market took this quite well. The UK, for the benefit of our our UK audience, growth has been coming down. It's been revised down. So this is a study by the Financial Times that summarized various institutes that had made forecasts. Since then it's come even worse. I think this chart is a bit dated. Economic growth is even worse than forecast. We had a recession last quarter. We were down 0.1%, and inflation is still on the rise. Now you can see the perils of doing these sort of charts analysis a couple of days before the big event. So you have to forgive me. I did this on Tuesday, and since then we've had data coming out. So now, of course, the UK inflation rate is 3.7%, which is not good, because that, of course, is this double-headed monster where you have falling growth and rising inflation. And here we're expecting 2.5 more rate cuts, similar terminal rate as the US of sort of 3.5. Let's see. Earnings are just around the corner, as always. That's why the timing of this webinar is always so interesting. We look at the previous quarter, try to get smart about it, but of course we don't know what the earnings are going to be, which are of course so telling. So this is a data set put together by FactSet, which do a lot of great research, and they're sort of looking at the year-on-year growth in earnings from the previous quarter. And as you can see, first of all, the actual tends to be higher than the estimated. You can sort of look at this in a number of different ways, one of which is that companies like to under-promise and over-deliver. This is the game that Wall Street likes to play. Doesn't always work, of course. But what I want to draw your attention to is, of course, is that it's going down. So both the estimated and the actual earnings growth has been decreasing. We'll see what happens now. Tariffs are still, there to be had. There's a new round of threats going on right now with the EU to August the 1st. So this chart here puts together the increases in tariffs that have now been put into place, and sort of the darker the color, the worse. And what's interesting, of course, is the neighbors of the US are being hit quite hard, and Europe, a traditional ally. Of course, China is negotiating their deal right now, but tariffs are still very much driving the markets, and geopolitical risks maintains its larger than really wanted risk level. So this is a study put together by BlackRock, and it looks at the number of mentions of the word geopolitics and whether it's negative or positive associated with it. For those of you who want more information, that's why I left the little disclaimer at the bottom. It's quite interesting. So this is sort of trying to measure also how not only how people report the news, but how they perceive the news. And you can see here, when geopolitical risk is really something that everybody talks about, everybody reads about. So this is the Russian invasion of Ukraine here. We have COVID here, and at the moment, after all the Liberation Day, economic blasts, it's hard to keep track what's happened in the last 6 months geopolitically, but we seem to be sort of at a elevated state still. That is without question. So there you have it. The drivers of markets are always the same. Liquidity, inflation, growth, earnings, geopolitical risks, macroeconomics. So all these indicators are telling their story, but nothing, of course, speaks to us like a good picture. So let's have a look to see how the markets have actually performed. We start with the S&P. Again, one of the biggest benchmarks that used out there, particularly by professional traders. And what I'm showing you here is a chart that looks at also the intraday movements of the traded volume. Now, if you compare this to this chart that I showed in the beginning, this uses end of day prices, and that's why this curve is so smooth. It tells you one story. What it doesn't tell you, and that's why I'm showing you this chart, is that on an intraday basis, the S&P in April, dropped all the way to 4,800. Now on an end of day, I think it was, that it closed at 5,000. But certainly things traded down here. People bought and sold this index at these levels. And why is that significant? And that's because this is the high, the previous high from 2021. And if you look at this basis, at this level, sort of from a chart technician standpoint, there's a couple of things here. One is that, this is obviously a support, but two, also, and this is where the symmetry of this picture comes in, which is, very lovely, is that it's sort of right in the middle of the lows and the highs of the previous trend. And that means that if this is broken, people will get sell signals and they'll start selling. Now, as it happens, we bounced off this abyss, and that's now make it so beautiful, in as much as we've tested this all-important level, we've bounced off it, and we're now making a new high. So the S&P 500, from a technical standpoint, looks great. Now, this chart here looks at what has happened within the stock market. Now, again, this is US-centric. We're looking at value stock versus growth stocks. In this case, it's the Vanguard indices, which are quite common. And what you can see that's interesting, so again, what it shows you is the performance of growth stocks versus value stocks. So this is people, voting with their hands and changing their allocations. And it's been quite violent, to be honest, which is what this bottom chart shows you here. So you're buying growth, you're selling value, and this is kind of, sorry, the other way around. You're buying value, selling growth. And this is kind of shows you what the performance has been. So if it's green, that means values are performing. If it's red, that means growth is outperforming. And this is where we are now, at a very interesting level, and particularly because this is April, when the S&P touched 4,800, so value in high demand, and now it's a complete opposite. So as a trader, you can look at this in one of two ways. Either you go against this trend, or of course you think that it's broken, but that's what people with higher pay grades than I do for a living. Also interesting is to look at the performance of the US versus Europe. You might recall, a very long time ago, there was whole talk about exodus from US assets into European assets. There are still reminiscences of this trade in the currency markets, which is what I'll show you in a moment. But this is the performance of the different equity regions, and that of course is what everybody was talking about at some point. Do we now take away out of the US and put it into European or emerging market stocks? So this is the performance now year to date. Now the interesting thing is that the S&P is down 19% versus the Euro stocks. So this is relative here. I don't know why it made the Euro stocks the base value, but this is a relative performance of each. So the Euro stocks is actually the best performing index, better than the UK by 6%, better than the emerging markets by 9%, and better than the S&P by 19%. Now, before you get too worried, what I've done on the right here is also showed you the same performance over 5 years. There you can see that US stocks, despite this 18% difference here, are still very much outperforming European and particularly emerging market stocks. But there's a reason for this outperformance, and if it isn't in the equities, then it has to be in the currencies. And this is where the pain has really been felt for those of us, of course, on the wrong side of this trade. So this is a performance of the US dollar, and what we're looking at is the DXY index, which is a basket of the major currencies, mainly the euro. But this gives us sort of a broad indication of what the dollar has done, and it's down around 13% from these peaks at the beginning of the year. So if you now look at this chart again and you look at this underperformance of the S&P, most of that is because of the dollar performance. Now, looking at this chart, it looks horrendous. The dollar has broken this big support that's been in place for 4 years. It's confirmed it, it's broken it again. It's nowhere near this trend. As a trader, you'd think to sell this. Now, and this is where the perspective is so important. If you look at the same chart, but longer term, so this is 5 years, and this is 15 years, you can see now where the perspective is so important, and what looks to be quite a horrible chart all of a sudden looks quite interesting, because this support line, which goes back, to the depth of quantitative easing, it has never been broken, not even now, and we have bounced off it in a little bit. So that gives me a bit of hope that maybe this dollar weakness has now run its course, but we shall see. Long-term yields are also the big story. Obviously, we've looked at near-term rates with these rate cut expectations. So these are now the long-term rates. And what makes these significant and why we look at them is because they're harder to manipulate. And it almost pains me to say this because it would have been unthinkable 30 years ago. But since quantitative easing, we've sort of gotten used to central banks manipulating yields. And you can particularly do that on the front end of the curve. Otherwise, by setting monetary policy, of course, which is what Trump now wants to do. But the long end of the curve, you actually have to go out there and buy these bonds to get the yields down. And that hasn't happened now for a while. So we've had this massive drop in interest rates since the 80s, really. And this is what our parents keep telling us about, is that rates right now aren't so bad. It used to be a lot worse. But this is certainly a big breakout now in terms of the regime. And again, for those of us who grew up sort of, trading in the noughties when money was cheap and free, this is quite a different phenomenon. And you just wonder where this is going to go. My point being is that, this was always utopia. We were never going to have free money forever. So we were always going to, quote unquote, normalize. Now, I think we were well on our way until COVID hit, which meant we had to double down in a sense and just buy the whole thing again. But it's just the speed of which we've now negated 10 years of monetary policy in a year, and you just wonder where the cracks are then felt throughout the great financial system, which nobody's ever figured out how it all works. But as the slightest things can sometimes cause big ruckuses. This is a pretty big thing, so let's see. The other thing that I thought was worth pointing out is what's happened, again, this difference between short and long-term rates. And here again, now we're looking at our friend the UK, and similar to the US, the monetary policy has been very similar. As a matter of fact, rates are exactly the same. I know that they're 25 basis points different, but they're sort of basically the same. And this is the difference in white between 1 year yields in UK bonds, in UK gilts, and in blue you have the 30-year yield. Now, in a normal world, short-term rates are lower than long-term rates. That's what used to exist before quantitative easing. That got turned on its head for quite a long time, which is bizarre. But now what's interesting is that we've certainly inverted in a good way. Short-term rates are now lower than long-term rates, but it seems to be a bit much. And this skew between short and long-term rates of now 1.7% is almost double what it is in the US. And of course, it is signaling that there's a bit of worry in terms of how the UK is going to get its fiscal books in order. And of course, we'll know more in October on that note. In the meantime, watch this spread. And there's more trouble ahead in bond land. So these, again, are long-term rates. And this is Germany 30-year rates and Japanese 30-year rates. And they're both now above 3. Why is this important? Because, of course, 3 is a lot better than 4, which is what we're suffering with here. And that is because the Germans price everything off long-term rates. Because here, of course, in the UK, we do everything 2 and 5 and 7 years for short-term rates. So in Germany, this is now adding quite a bit of juice to the mortgage rates, which means there's a bit of supply issue there now. And Japan, they haven't been this high, in a long time. And of course, they're now in their 40th year in terms of the yield curve control. But this again is something that will be very difficult to control given the size of it. The debt to GDP ratio in Japan, I think, is 265%. And so, I don't think they'll be able to manipulate this any further, if they want to finance long term. Oil's not doing much, which is surprising because geopolitically, certainly there still seems to be a lot going on. There's now, of course, growth has been written down on the global basis, so there's that. Also, a lot of the governments that are holding the gauges open, they need money. Their budgets need money. So OPEC has now, of course, also increased production. There's also this expectation that things are under control geopolitically. which is a big assumption, of course, but oil hasn't done much at all. And I think I keep showing you the same chart now in my fourth year. Sorry, I'm not making this up. Gold is not going down. And again, here we're looking at gold versus the S&P. That's because, people buy gold when they're worried, sort of the ultimate safe haven. So you kind of see them going in reverse directions, which is also why gold can be a good hedge. When S&P goes down, gold goes up. But for some reason, gold isn't playing ball. And even though the S&P is now going up again, gold is still up. Don't know what that means. There's also a lot of pressure coming from the US dollar and how that moves. But again, just thought it's an interesting one to watch. Certainly for now, it doesn't quite fit the picture of the other markets. And then finally, Bitcoin is on fire. This is a log chart. Yes, we add value here at blue. So this just normalizes the great volatility of this instrument. But this is a 10-year trend. And if you look at that, this has made you nothing but happy. And, recently, of course, back to this all-time high. But there, if you can stomach the volatility, it's been a one-way ticket. So these are the markets. We've looked at the drivers, we've looked at the markets. So now, what's the crystal ball? What can we expect now going forward? This is a very complex chart. I do show it regularly, so you will get used to this, is what I was saying. So the way to read this is really looking at the PE ratios of certain regions. And PE ratios, of course, are a very crude measure of valuations. And what you're seeing here by these grids, that's sort of the average, the 80% percentile. That's where most of the occurrences have been over the last 20 years. And you can see where we are current. So this is telling you that we are above the average in the US. This is the developed world. This is Europe. This is Japan. So you can see Japan is sort of, almost below the historical rates. And yeah, the emerging markets are also trading expensive. The UK isn't. It's sort of almost right in the middle. This is another way of looking at it, in case this is the previous one was too complicated. So if you look at all the global PEs, you have an average of 19.5, which is elevated, but not stupid like it was in 2000 or on the back of the COVID stimulus. And take that for what it's worth. The risk markets are always a good indicator of how people perceive things to come. So what we're looking at here is the VIX, which is the measure of volatility on the S&P 500 index, and the MOVE index, which measures volatility in the bond markets. Don't worry about the numbers. The only thing you have to know is that anything above 30 in the VIX means we're panicking. Anything sort of below 15 is where it's normal. That's why that green line is here. And incidentally, also for the MOVE index, anything below 100 is good, and anything above 100 is sort of risky. So you can also see here that both risk markets are giving us the all clear. It's all good. There's no worry out there, no big risk. It's all good. Yeah, everyone is bullish. So we came out of this huge drawdown in the S&P. April, a long time ago, markets dropped almost 25%, and people were extremely bearish. And now, very quickly, all due to the expectations that things aren't going to be as bad, maybe as expected. Optimism has now surged to a multi-year high. No one seems to be scared. So April, we all thought, yeah, the recession is nigh, the end is nigh, run for your lives. And 2 months later, yeah, there's no problems at all. Tariffs are not an issue, war is not an issue, the economy is not an issue, inflation is not an issue, we're good. Powell's our man, and long may he stay in power. Greed is good. Fear and Greed Index, this is from CNN. Sorry, I need to reference this. So this is a CNN. There's many of these out there, and what it is, they phone up a segment of the population, just ask them, how you're feeling right now. So it is, a measure of behavior, of human behavior. And right now, it seems that, we're all, fearful that we don't have enough because things are going up and everyone is bullish. On that note, and this is also something that we'll do on a regular basis now because it's just so much fun. So what we have here, and I showed you this chart here on the left, sorry, I showed this chart last time. So these are the Wall Street forecasts for the end of year value for the S&P 500, which, as you know, is one of the main benchmarks that people look at. And what you saw back in April when we had this webinar, remember things weren't so good, is that all the analysts, except for Deutsche Bank, ran for their lives and lowered their estimates for the year end by a lot, as much as 1,000 points by the smart guys at JP Morgan. But now, and I can't quantify exactly what's happened, but markets are up and they've changed their mind, except for HSBC, bless. But most of them now all expect, the markets to do well. Interesting, Deutsche Bank, who were so fearless last time, I guess they finally chickened out and said, yeah, maybe just 6,500, which is quite a drop, by the way. But in any event, that's what Wall Street thinks is going to happen. So what could possibly go wrong? Yeah, who's going to buy this stuff? So if everyone's bullish, everyone's bought in, where's the money going to come from? It ain't from cash. So these are the cash levels now. So this is allegedly measuring how much cash fund managers are keeping. So this again is a measure of risk out there. And that's now fallen to quite an extremely low rate. Doesn't matter that. This is not necessarily the best sell signal. It also gets it horribly wrong because of course you can also leverage, you can borrow to buy things. But in any event, it is interesting, and that's one to worry about. It always worries me when everything goes up. Luckily the bond markets have stopped going up. That would have really had me worried if equities, bonds, cryptos, commodities, if everything goes up, then this becomes very, very pertinent. But luckily there's been some differentiation lately. So particularly if there's a rotation in markets, things can turn. Certainly, uncertainty remains high. The inflation rate, I showed this earlier on, we've come a long way. We're near the target, but by no means are we through the pain period, and particularly if these tariffs now come in. And remember, economic data, it kind of takes 6 months for these things to sink in. So, when these tariffs were put in place, that's now been, enough time for it to then show up in the data. And by that, we also mean earnings, which I'll come to in a minute. But you just saw UK inflation was 3.7. We're not out of the woods yet. It's not like we can now lower rates by 1%. Geopolitical risk remains elevated. I haven't got the memo yet, but from what I saw, they're still shooting at each other in record numbers, which isn't great. How does it affect the financial markets? Rather morbidly, it can be in one of two ways. Certainly the German stock market miracle is purely driven by defense spending now. Which is quite clear, but of course it's the supply chain and input prices. That's really where geopolitical risks do their damage. And the tariff war is far from over. As far as we know, there's new legislation coming out every day, new threats coming out every day. There's trade agreements being negotiated in the background. I think so far we've got 4 done, but of course, we need 200. And so there are bound to be frictions and supply chain issues and people buying ahead of time because they're worried, and then they don't, and then the ships are full, but they can't dock. So this is all not exactly conducive to an efficient global economy. And that's where we now are. And that's why also this webinar is called, Summer Bill. We're not going to see what all this commotion in the last 6 months has done. And the most sensitive parameter of that is in earnings, because ultimately, the economies are driven by consumption. In most developed economies, it still makes up 70%. So what we do, how we feel, how we spend our money, that is, all that matters. And, it then, obviously filters through to earnings from the stores and companies that we buy our goods from and services. And what this chart's telling you is that we've been revising this bill upwards. So this is the irony, as growth has come down, the bill is higher. It could be because of the taxes that are now in play. We're still growing So that's the good news. So despite everything, the economy is still growing. If anything, the labor market is almost too strong for some of the central banks to consider cutting. But we shall see. And with that, we shall now endeavor to make a call. And that's the nice thing about these webinars. After all this information, after all this insight, and after all this terrific analysis, we now get to make a bet. And as always, we asked our audience, is the S&P going to be up or down from last quarter? And it is end to end, so we can't cheat. Because it's of course not the middle of the month. But 56% of us thought we would be up, and survey says we're up 10%. Now we weren't always. Remember, we did go down to 4,800, but that's a nice result, and well done us for sticking to that. The next question we asked is what's going to happen to this dollar, and I can promise you we're going to ask you that again because it's just so interesting. And what's the euro going to do against the dollar? So most of us thought it's going to go down, so that means the dollar will strengthen, and of course survey says it went up, and that means 59% of us got it wrong, which isn't unusual for currencies. And then finally, we asked, and this was very pertinent, this was on our minds last quarter. Can you imagine that we talked about something as banal as this, given the context of everything else that's happened since? But yeah, the US-UK trade agreement, will we have one or not? And there you go, 58% of us thought, yes, there comes some sort of agreement and it'll be fantastic. And of course, we did. Now, without further ado, I will now ask the audience, and you will now quickly see a little poll screen. You give us your votes, and you tell us whether or not you think the S&P 500 is going to go up or down from here by September the 30th. And we'll talk about it 2 weeks later. Hannah, are the results coming in?
Yep.
Great.
Looking 50-50.
50-50. Oh, all right. I said up, but you got to go with what doesn't make sense. What will sterling do? So no longer the euro, but what's our favorite cable going to do? We are now, interestingly, where were we at the beginning of the quarter? Hannah, we got to look that up. I think we're a bit higher. So I think because of that, I think here now we take today's level, Hannah, please. So otherwise they would be cheating. So I think sterling right now is at 134. So audience, please vote now. Is cable going to go up or down from 134? Done, Hannah? What's it look like?
Okay, majority says down.
Interesting. And then finally, for those of you who just watched the latest Grand Slam at Wimbledon, what a show. These guys really are in a class of their own. So they warned us figuring out who's going to win amongst them, but we also wanted to be fair. So you can choose Alcaraz, Sinner, or someone else to win the US Open. And I'm definitely going to go with Alcaraz for my part. Dun-de-dun-de-dun. Wonder how many will pick other. So dominant. They've won the last 7 Grand Slams now between them, Alcaraz and Sinner. So this is a warranted question. There's a pattern there. Hannah, what does it look like?
Majority says Sinner.
Really? Huh. Yeah, he was very good. I have to admit. Right, we're on time. I'm glad to speak. So we have plenty of time for Q&A. Before I do that, again, I just want you to be aware of the wonderful things that we try to do to keep you informed of what's going on. The morning call is coming. We now have our best people on it. So this will be an interactive morning call every day at 9 o'clock. We'll go through various markets for 15 minutes. And again, there'll be a poll. We're opening this up now to our clients. We've done this internally for the last 4 years, and we're now making this live. So watch for announcements there. We also write a weekly blog unless I'm on holiday, so apologies. Last week there was none, but there will be one on Monday. So we pick up the big stories from the week before, put 250 cynical educational words around it, and there you go. And then finally, we have these quarterly webinars. And without further ado, I give it to Hannah, and let's see what the audience wants to talk about.
Okay, so first question, what are the biggest risks for the markets for the rest of the year?
Yeah, where to start? That the pace of the things that are happening is just flabbergasting. That's why I can't even remember all the things that happened in January, February, March, and April, or May, or June, because it's just so full of events and policy changes. And as such, I think that the biggest risk for the market is going to be this ongoing uncertainty. I just don't think we'll get any certainty anytime soon, and that's also not because Trump doesn't also know how to change his mind if he does say something. So I think we got to get used to that. Which is why I thought it was interesting that insurance is so cheap. The bond markets still don't seem to agree with that assessment. So that that surprises me. If you want events ranked sort of in decreasing order, what's the likeliest culprit to cause damage? Apart from the wars escalating, which is sort of option Z, which I hope we never get to. There'll be a lot of threats, but hopefully this isn't the beginning of the end. But it's the tariff story. It's just how the US is positioning itself now. And I think Trump is now also aware that he's running out of time. He's got the midterms next year. So as of 2026, all the eyes will be in the campaign. Nothing will happen anymore because it's all about spinning the new message. So he's got the next 6 months to sort of push as hard as he can. He's going as fast as he can. He's pushing as far as he can. And we'll see how far he can go. The jury is out there in terms of the trade agreements that he's pressuring these big blocs to sign. The European Union ain't small, neither is China. They don't have to do everything the US wants. Don't forget, China only now, I think, exports less than 50% of its goods to the US. The rest is in Asia. So that's also where these threats, they're not necessarily landing in the way that the US may want. So we shall see what happens. I think it's just politics. That's the biggest risk and uncertainty.
Okay, second question, what is your forecast for the pound?
Oh my God. This must be from a client that knows me well, because then they know that I always get this wrong. So it's quite possible that he wants a contra indicator here, whatever I say. So the reason that the pound would appreciate from here is not to do with anything the pound does, but it's all about the US. And also what you're seeing right now, perversely, it's obviously a pair. But it isn't the strength of one, it's the weakness of the other. And therein now lies the big conundrum. What is this dollar going to do? So I showed you that long-term chart. So chances are, we've seen the lows now. But if there's another ruckus, another geopolitical explosion, and then pension funds start to really pull their money out, then who knows what could happen. Some of the smart people that I follow are Oxford Economics. They provide some nice research. These are the guys who will sit there and they'll look at increases in consumption here, an increase in probability here, an increase in wages there, an increase in taxation there, and increase in discretionary spending there, and then they go on, holding everything else constant, by the way. But Oxford Economics has some pretty smart people. They think the pound is going to 125 to 130, which is kind of whence it came from, and not on the lows, but certainly no nosebleed here in the 130s. There are others who think the new normal is 130 to 140. I'd have a hard time believing we break 140, and unless something really bad happens, like a Liz Truss event, I don't see the pound going below 120 either. That's about as good as I can make it.
How am I positioned? I'm slightly short at the moment, for what it's worth. Next question, Hannah.
Is there a way to buy insurance against a large market drop, and at what cost?
There is indeed, and this question must have clearly come from me throwing around words like insurance is cheap. So depending on which market, of course, but you can buy financial derivatives, you can buy put options, you can also sell calls, and obviously you can just buy indices like the VIX, which is a volatility index that works like options in theory. It's kind of complicated, but just trust me on this. And what you're paying for is the level of risk that's priced into the instruments. And right now, with where the S&P index is trading and where the bond index is trading, it's relatively cheap to protect yourself. So if you have £1 million and you want to protect yourself against a 20% drop in the markets, it'll cost you around 1% or 2%. Yeah, quite cheap. But of course, the problem is that if this drop doesn't come within the next 3 months, then you got to do this trade again. And that is where timing the crash, you can buy insurance, no problem, and it is cheap right now, but you can't have a free lunch. You can't insure yourself, and it being cheaper than the risk you're taking of it dropping, if that makes sense. So long answer. Hopefully that was all coherent. But the solution is, if you're really worried that markets are going to drop, there's two options. Either you sell part of your position, you sell 10 or 20%, and you'd be amazed how much better you feel already, or you buy some 10 or 20% out of the money options for the next 3 to 6 months, and you'll sleep better, obviously at a cost. Hope I've answered that in a good way. If not, please email me and I can elaborate on that a bit more. It's not easy, these financial derivatives, how they work. But just remember, there's no free lunch. They're very clever people who trade these things. So there's no magic thing that we can do to protect ourselves against losses and still make money. Next, unfortunately, I tried. Next question, Hannah. Risk-free profits. Imagine that. Hannah, next question, please.
Is the US debt going to be problematic following Trump's big bill?
Yeah, I think so, and that's just because he's seemingly to it, right? And it was already pretty high. Now his bet is that debt will induce growth, and that the growth will be higher than the debt. This is very Keynesian, very, very traditional economic theory applied. The problem is, that works, yes, in theory, but if you then meddle with the supply chain, it kind of takes away these benefits, and that's why, again, there's no free lunch here. I've said this from the very beginning, and for those of you who've watched my webinars now for the last 6 or 7 years, I've been going on about this debt that we've accumulated from quantitative easing for a long time. And, it wasn't a problem, when interest rates were at 1, but now they're at 4. And you can see how that's taking up a huge part of our governmental budgets now. It's just making interest payments. So, that can't be a good thing. The problem is, how do you get rid of it? Because to get rid of it, you have to take things away from people that are used to getting it. That's why also, it's very difficult to cut budgets. People are dependent on these things. And so it really then comes down to, how you manage the rest of your economy. And if productivity is rising, and if you're, reducing the bureaucracy and making it easy for people to invest and giving people also incentives to earn more, which is the opposite of what we're doing here, then this equation can work. And that's why also, for as insane Trump can seem, and I say this, without any political bias, I'm just going by, someone changing his mind all the time. That's not normal. But as, insane that may appear to a mere mortal such as myself trying to understand these things, it could work, really. And so,
in that regard, you also can't just now, go to cash and wait this one out. You got to keep invested. Obviously, and then hopefully this is the next part of your question. You diversify yourself a bit. You don't just buy the S&P 500 index, right? You buy some bonds, you buy some alternatives, you buy some gold, you buy some Bitcoin. You have a diversified portfolio. So you're still, making money on the way up, but of course on the way down, you're not betting the whole ranch. And that's all I can say about this. It worries me, the U.S. debt. It's worried me for a long time, but so far it hasn't manifested itself in a meaningful way. And we're at record highs, right? So no problem. Hannah, I think we've got time for one more question.
Yep. Will Chair Powell make it through to the end of his mandate?
Well, I love this question. We were talking about it this morning, and someone mentioned that, irrespective of what Trump may do, but Powell may just quit. And just say, you know what, enough of this. I mean, who needs this? The guy is fabulously wealthy. He's had a long, distinguished career. He saved the world after COVID, so he doesn't have anything to prove. He might just say, look, guys, I'm off, like Cartman from South Park. I'm out of here. I'm going to go to the Hamptons. Good luck to you. And I think that would be a major catastrophe at this point, because he is, for all his faults, but Powell, he was elected in the right way. He's part of a system that's worked well over the last decades. You can say what you want, but the Fed has been a great success, irrespective of the bubbles may have caused, but it was very good at fixing them as well, seemingly. And so in that regard, if that pillar of independence, if that's now taken away and Powell does resign or Trump fires him, before June next year, that would be a big problem. Now, I think Trump has enough people around him, like Bassett, who will let him know what I just told you. Was I don't have any great insights here. This, everybody knows this. If you fire the Fed chair, we're all doomed. So, will Trump go there? It seems unlikely, and he actually said that. And so the hope is that, by the time July next year rolls around and Trump then gets to pick his preferred candidate, we're so far into the midterms that he's not going to do something radical. That's my hope. So to answer the question is, I hope he doesn't resign. I don't think he'll get fired, but who knows what happens next year when he does end his term. That much is clear to him. He's not going to get another term. So also his decision making will be driven by that. Hannah, unless we have another pressing question, we'll leave it here.
Yeah, all good.
All good. Wonderful. Well, thank you so much for joining us. And again, please do stay in touch. Reach out via email if you want to chat about anything. And also keep giving us feedback on the webinar. We want to make this as good as possible for you. Focus on what's relevant. Keep you abreast of what's happening. And of course, also make you aware of the risks that are out there. So stay good, stay alive, have a great summer, and we'll speak to you in October. Thank you very much.